Have you ever watched your investments soar only to hesitate on when to cash out? Or maybe you've sold too early, kicking yourself as prices continue to climb. If so, you're not alone. The age-old dilemma of when to take profits and when to hold is a challenge that plagues investors across all markets. Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. Investors constantly struggle with timing, profit-taking versus holding, because no one can perfectly predict the market. Selling too early might mean missing the next big rally, while holding too long might wipe out hard-earned gains. This dilemma exists in every asset class, whether you're dealing with stocks, real estate, cryptocurrencies, or commodities. Behavioral finance shows us that the psychology of fear and greed plays a significant role in our investment decisions. Fear of loss often drives people to sell too early, while greed can make us hold on to investments well beyond rational levels. Understanding these emotions is key to making better financial decisions and navigating the complex world of investing. So, when should you take profits? One clear indicator is when you've achieved your price target. If you entered an investment with a specific goal, such as a 20% profit, it's wise to respect that target. Successful investors don't chase endless gains. They lock in profits once their original strategy is met. This disciplined approach helps maintain consistency and reduces the risk of emotional decision-making. Another crucial factor to consider is changing fundamentals. If a company's earnings start to decline, industry conditions worsen, or macroeconomic signals turn negative like interest rate hikes, that's often a cue to reduce or exit positions. Paying attention to these shifts can help you stay ahead of potential downturns and protect your wealth. Warning signs shouldn't be ignored. Falling revenue, shrinking profit margins, or management issues can foreshadow bigger problems. In the world of cryptocurrencies, warning signs might include regulatory crackdowns or liquidity concerns. Being vigilant about these red flags can save you from significant losses. Sometimes, taking profits isn't about weakness in an asset, but about maintaining a balanced portfolio. For example, if one stock grows from 10% to 40% of your portfolio, it makes sense to trim that position and diversify. This rebalancing helps manage risk and ensures you're not overly exposed to any single investment. But what about holding? When should you resist the urge to sell and stay invested? Long-term conviction is a powerful reason to hold. If you believe in the future of an industry, such as renewable energy, artificial intelligence, or biotechnology, holding long-term allows you to benefit from sustained growth trends. These big-picture bets can pay off handsomely for patient investors. Strong fundamentals are another good reason to hold. Companies with consistent revenue growth, strong leadership, and competitive advantages are often worth holding on to. Think of tech giants like Apple or Microsoft. Both have rewarded patient investors with incredible returns over the years. The power of compounding is a compelling argument for holding investments. Time in the market often beats timing the market. Staying invested allows dividends and reinvested gains to compound, potentially multiplying your wealth over decades. This long-term approach can be far more effective than trying to jump in and out of the market. Holding can also help you avoid emotional decisions. Short-term market dips often trigger panic selling, but many of these dips recover quickly. Rational investors learn to avoid reacting to market noise and stick with their strategy, understanding that temporary volatility is part of the investment journey. Let's look at some real-world examples. Many early Apple investors in the 1980s sold at small profits, missing out on the company's exponential growth. In the 2000s and 2010s, similarly, countless investors sold Tesla stock before it became a trillion-dollar company. These cases illustrate the potential opportunity cost of selling too early. On the flip side, holding too long can be equally devastating. During the dot-com bubble, many investors held onto speculative internet stocks until they collapsed by 90% or more. In the cryptocurrency world, we've seen similar scenarios with investors holding altcoins through massive crashes, wiping out substantial gains. The key lesson from these case studies is that balance is crucial. Selling everything to early caps your growth potential, but holding blindly risks ruin. The right decision depends on a combination of fundamentals, strategy, and personal financial goals. So, how can you make smarter decisions about when to take profits and when to hold? Start by developing clear entry and exit plans before you buy. Define your profit target and stop-loss level in advance. This approach reduces emotional decision-making when the market gets volatile. Consider using tools like stop-loss and trailing stop orders. These can protect your gains automatically. A trailing stop, for example, moves up with a stock price, locking in profits while still allowing for upside potential. If the stock continues to rise, another effective strategy is to balance profit-taking with letting winners run. You might sell a portion of your position to secure profits while keeping some exposure in case the stock continues to climb. This approach gives you the best of both worlds: realized gains and potential future growth. Regular portfolio reviews are essential. Quarterly or annual reviews help you identify overexposure and rebalance based on updated goals and risk tolerance. These check-ins ensure your investments remain aligned with your overall financial strategy. Remember, effective risk management is crucial. Your approach should align with your personal goals. A retiree might focus on protecting capital, while a young professional can afford to take more risks. The right decision depends on your life stage and objectives. One way to protect gains while still growing your wealth is to move profits into safer assets, like bonds or index funds, while maintaining some growth positions. This strategy allows you to lock in wealth while still investing for the future. In conclusion, the decision to take profits or hold comes down to a few key factors. Sell when fundamentals deteriorate, your goals are reached, or when your risk exposure becomes too high. Hold when your long-term conviction remains strong and the fundamentals of your investment continue to look promising. Remember, discipline beats emotions in investing. Stick to your plan instead of reacting to every market move. Have you ever sold too early or held too long? Share your story in the comments below. We'd love to hear about your experiences and lessons learned. And don't forget to like this video, subscribe to our channel, and hit that notification bell to stay up to date with more investing insights. Until next time, keep growing your wealth wisely.